Warren Buffett once said the best business to own is one that has a monopoly. If you have a monopoly, you can set the price, and that's the single most important decision in evaluating a business. And he's right. Monopoly businesses enjoy pricing power, massive profits, and a competitive moat that keeps rivals out. In India, a few companies have established themselves as dominant players with little to no competition. But how do these companies reach such a position? And as an investor, should you be looking at them? In this video, let's embark on this journey together as we unravel the secrets behind India's monopoly giants. Let's begin. You're watching Informed Investor, an initiative by Equentis. The first things first, what is monopoly? A monopoly refers to a market situation where one producer or seller controls the entire supply of a specific product or service. This dominant position allows the company to influence prices and creates challenges for new competitors trying to enter the market. The Indian stock market provides a diverse range of investment options across various sectors. While true monopolies are uncommon, certain companies enjoy substantial market share and hold a competitive edge, often regarded as dominant players or leaders in their respective sectors. Here's a simple example. In the past, Doordarshan was the only channel available for television broadcasting, especially in rural areas. This gave it a monopoly on TV entertainment and news. Or in many countries, Coca-Cola is the dominant brand in soft drink market. While there are other brands, Coca-Cola has such a large market share and recognition that it can influence prices and availability. Let's discuss this in detail. In a monopoly, a single seller controls both the supply and pricing of a product, leaving no room for competition. In Indian market, the company with the largest market share typically holds the position of a market leader. Monopolistic products generally lack close substitutes, allowing the company to operate without the threat of competition from similar or new products. Another defining feature of a monopoly is the presence of high barriers to entry and exit for businesses. These barriers can stem from factors such as licensing requirements, patent protections, or government regulations. Monopolies can also take advantage of bulk purchasing, efficient resource management, and specialized equipment, which helps reduce per unit costs, a phenomenon known as economies of scale. Firm and industry are one and the same thing in case of a monopoly. So the firm has complete control over the industry output. This gives a monopoly right to fix the prices, hence it's a price maker. The price can be influenced by changing the supply of the product by the firm. Now, how does a company achieve a monopoly, you might be wondering? In the Indian market, companies with a dominant share of over 50 to 55% can be classified as monopolies, and those with merely total market control like IRCTC and HAL are government-backed monopolies. These companies are established by the government to oversee important sectors, often for reasons such as public safety or national interest. Their performance is heavily influenced by government policies, regulations, and contracts. Next, brand recognition can also help companies become monopolies. For instance, Colgate is often used interchangeably with toothpaste, and Maggi is a household name for noodles. This brand strength, built on consistent quality, extensive marketing, and strong distribution, creates loyal customers and drives continued growth, making these companies attractive investments for the future. Now, some monopolies arise due to the inherent characteristics of an industry or resource. These are referred to as natural monopolies, often seen in sectors like utilities such as water or electricity, where one company controls essential infrastructure or resources. This creates a dominant entity with significant market power. Lastly, vertical monopolies emerge when a company dominates multiple stages of production or distribution within a specific industry. By controlling both supply chain and distribution process, such companies streamline operations and secure a strong hold in the market. Reliance Industries Limited is often cited as an example of a vertical monopoly in India. RIL interests in various sectors including petrochemicals, refining, oil and gas exploration, retail and telecommunications, controlling several stages of the supply chain in these industries. Now, let's have a look at the top 10 monopoly stocks in India along with their market share. Most of these companies are operating in the essential sectors with limited competition. Along with the market share, we have also mentioned the industry in which the company has a monopoly. Some of them are government monopolies like IRCTC and HAL. Companies like Coal India and Hindustan Zinc are natural monopolies. Now, to give you a better picture, let's take a look at these companies in detail. When we talk about monopolies in Indian business landscape, one company that immediately comes to mind is the Indian Railway Catering and Tourism Corporation. Let's explore why IRCTC is often cited as a prime example of a monopoly in India. Firstly, let's understand the revenue streams of IRCTC. The company offers four major services to the Indian public, namely e-ticketing, packaged drinking water, catering and tourism. IRCTC holds exclusive authorization from the Ministry of Railways to provide online ticket booking services for Indian Railways. Its website and mobile app Rail Connect are primary platforms for millions of passengers every day. The e-ticketing segment contributes a significant 28.8% to the company's revenue. In catering services, IRCTC is India's largest hospitality provider, offering meals on trains and at railway stations. This segment, along with various ancillary services, accounts for about 45.2% of its total revenue. IRCTC also has a monopoly in the production and distribution of packaged drinking water under the brand Rail Neer. With exclusive rights from the Ministry of Railways, Rail Neer is available at all railway stations and on trains, contributing 7.8% to the company's revenue. Why IRCTC's monopoly in the Indian Railways ticketing market is a big deal. Think about booking a train ticket in India. Chances are you have used the IRCTC website or app. It's practically synonymous with Indian Railways ticketing. That's because IRCTC enjoys a near monopoly in this space. But why does that matter? In essential services like railways, customers often don't have much choice. Where else are you going to go to book a train ticket? This lack of competition gives monopolies like IRCTC a powerful position. They can generally count on stable earnings and consistent cash flow. People need to travel, and IRCTC is often the only game in town. However, it is essential to know that monopolies aren't immune to economic downturns. The COVID-19 pandemic significantly impacted IRCTC's revenues and margins, highlighting its vulnerability during such crises. Despite the setbacks during the COVID-19 pandemic, IRCTC has made a recovery with sales growing at a CAGR of 16.76% from FY15 to FY24. Despite a dip during the pandemic, sales surged from 777 crore rupees in FY 2021 to 4,270 crore rupees in FY 2024. Net profit also bounced back, growing at a CAGR of 26.81%. After a drop to 187 crore rupees in FY 2021, net profit reached 1,111 crore rupees in FY 2024, showcasing healthy recovery and growth. IRCTC's monopoly status is both a strength and a vulnerability. While it currently benefits from this position, any changes in regulations could disrupt its operations. If the government introduces competition in IRCTC sectors, it could hinder its growth. Retail investors should stay alert to potential regulatory changes as they could affect the company's ability to maintain its monopoly and influence its long-term outlook. Next is Hindustan Aeronautics Ltd, which plays a crucial role in India's defense manufacturing landscape. As a majority government-owned entity, HAL is involved in the design, fabrication and assembly of a wide range of aerospace and defense equipment. Their product portfolio includes airplanes, jet engines, helicopters, and various other related components. This involvement spans the entire life cycle from initial design and development to manufacturing and assembly. The company has stable revenues, growing operating margins, and strong ROCE margins. HAL consistently maintains a healthy dividend payout ratio, reaching 39% in FY24. In the last year, the stock offered a return of 11%, and over the last 5 years, the company delivered returns of 812%. Next on the list is Coal India Limited, a giant in India's energy sector. With control over more than 80% of the country's coal production, CIL is the central to industries such as power generation, steel, cement, fertilizers, and many more. As a PSU, it has a significant presence in the economy. However, its dominance raises an important question. Is this monopoly still necessary, or is it holding back growth and innovation? Founded in 1973 under the Coal Mines Act, CIL held near total control over coal mining and sales for decades. This monopoly allowed the company to regulate prices and shape the coal market in India. Coal itself is a non-renewable energy source, primarily black or brownish black in color, formed over millions of years from plant debris. It has a wide range of uses across various industries including steel making, fertilizer production, power utilities, cement ceramics, chemicals, paper and domestic fuel. Coal India's products are integral to the functioning of these sectors, cementing its role in India's industrial landscape. In 2020, the Indian government took a significant step by ending Coal India's monopoly through a Supreme Court ruling. Despite being a public sector undertaking, CIL was accused of misusing its dominant position in non-coking coal production and distribution. This ruling paved the way for private companies to mine and sell coal, marking a pivotal shift aimed at increasing competition, attracting investment, and modernizing the coal industry. Despite the entry of private players, CIL remains a dominant force as the world's largest pure-play coal producer. The transition is happening slowly with the challenges like land acquisition and regulatory hurdles causing delays. An interesting fact to know is the President of India through the Ministry of Commerce and Government of India holds the majority of shares of 63% as it is a PSU. The remaining shares of 31.2% are divided amongst the FIIs, DIIs and retail investors. Now let's get into Coal India's financials and examine how its monopoly status influences its financial performance. Being the largest coal producer, it recorded revenues of 1.42 lakh crore in FY24, growing at a CAGR of 7.5% since 2015. The operating profit margins as well have been healthy throughout, with the latest reading in FY24 of 34%. When looked at the bottom line, its net profit grew around 37,369 crores and grew at a CAGR of 11.7%. Moreover, in FY24, it reported its highest ever coal production of a massive 773.6 million tons, an increase of 10% from the previous year. For shareholders, as you can see in the chart, it has maximized shareholder value and returns by providing a dividend payout of 42%, which implies that the company has channeled 42% of the earnings as dividends and has a trend of regularly rewarding shareholders via dividends. In terms of returns, Coal India has delivered over 100% returns in the past 5 years. And to conclude, while there is an evident shift towards renewable energy sources, coal will continue to be the dominant source of our country's fuel mix, as it offers reliability and stability of supply at affordable prices. Despite the entry of private companies post-2020, new entrants face challenges obtaining licenses and navigating complex regulations. Next up is ITC, a name that most of us are familiar with as it's a staple in many Indian households, known for its diverse portfolio, and just last year it became the 11th Indian company to cross the massive 5 trillion market cap. Originally established as the Imperial Tobacco Company in 1910, ITC is currently the largest manufacturer and seller of cigarettes in India. After solely focusing on cigarette business for over 60 years, the company eventually expanded into other industries. As of today, ITC operates in 5 segments and in the recently concluded Q3 of FY25. A major chunk of the revenue, about 42%, comes from the sale of cigarettes, followed by FMCG at 25.5%, which includes its flagship brands like Ashirwad, Bingo, etc. At 17.1% comes the agribusiness, followed by paper and packing segment at 10.1%. ITC Hotels comes in the least contribution to revenue at around 5.3%. But ITC stays true to its name and commands a market share of about 73% in the cigarette business. This dominance, however, comes with complex dynamics surrounding government regulations, competition and ethical considerations. Interestingly, India happens to be the world's second largest consumer of tobacco, and taxes on cigarettes remain one of the highest compared to other nations, as you can see in the chart. Taxes on cigarettes in India are multiple times higher than in developed countries. 14 times of USA, 7 times of Japan, 6 times of Germany, and so on. Now, moving on to the financials, ITC reported a revenue of 33,667 crores in FY24 from the cigarette segment alone, a growth of 7.6% from the previous year. Even if you look at the most recent data, ITC's cigarette business net revenue grew by 8% year-on-year to rupees 8,136 crores in Q3 FY25. Another point to highlight is that in the recent 55th GST Council meeting, the group of ministries on GST rate rationalization proposed a 35% tax on sin goods. While this has been proposed, it has not yet been implemented. If introduced, it could impact ITC's cigarette business by potentially affecting volumes. However, the company's strong focus on premium products and its increasing market share from illicit trade should help cushion some of these pressures. Moreover, even in the Union Budget 2025, the government did not announce any changes to cigarette tax rates. As a result, ITC is expected to maintain a steady 4 to 5% volume growth in the coming quarters. In terms of returns, ITC delivered 93% returns in the last 5 years. Overall, ITC has been a great defensive stock driven by strong cash flows of cigarette segment, high margins, stable business and attractive dividend, making it an appealing company in terms of fundamentals. With rising disposable incomes, consumers have more purchasing power, which is expected to support steady demand for ITC's cigarette products. This growing consumer spending power will help sustain ITC's growth in the cigarette segment, complementing the performance of its other verticals. Lastly, let's also throw some light on MCX. The Multi-Commodity Exchange of India Limited is a key player in India's commodities trading sector and stands out as one of the most notable monopolies in the market. Founded in 2003, MCX became the country's first national-level exchange focused on commodity futures trading. Over time, it has grown to dominate the market, offering trading platforms for a range of commodities such as metals, energy, and agriculture products. With a commanding market share of around 96% and operating under the regulatory framework of SEBI, MCX has become the primary exchange for commodity trading in India. MCX generates revenue primarily through transaction fees charged on trades executed on its platform. It accounts for a significant 82% of the revenues. The exchange also earns income from membership fees and other ancillary services. The significant volume of trades conducted on MCX contributes to its robust revenue generation. Now, moving on to financial performance of MCX, the numbers are somewhat mixed. For FY24, MCX reported a revenue of 684 crore rupees, marking a robust growth of 33.11% compared to the previous year. This growth trajectory has been consistent with a compound annual growth rate of approximately 13.32% over the last 9 years. When looked at the bottom line, the company's net profit for FY24 came significantly lower at 83 crore rupees due to high software support charges and product license fees. However, the last few quarters, the company has effectively managed costs and witnessed a profit of 160 crores in Q3 of FY25, as compared to 83 crores it achieved for the full year of FY24. For investors, MCX has proven to be a lucrative opportunity. The stock has experienced remarkable growth, rallying over 50% in just 1 year and more than 300% over the last 5 years. This impressive performance is underpinned by strategic initiatives such as expanding its products, offerings, and increasing participations in options trading, which has seen substantial volume growth. Interestingly, despite its dominant position, MCX faces challenges typical of any monopoly-like structure. Competition from other exchanges and regulatory hurdles can impact its market dynamics. However, its established reputation and operational efficiency position will help navigate these challenges. While investing in stocks of monopoly companies like the ones we've mentioned can offer lucrative opportunities, it's essential to evaluate both the potential rewards and the risks. Here's a look at the reasons why investing in monopoly stocks might be attractive, along with the risks to keep in mind. First, let's look at the advantages of investing in monopoly stocks. Monopolies dominate their industries, ensuring stability in their market position. This dominance often leads to consistent revenue streams and earnings over time, offering investors a sense of security. With limited or no competition, monopolies have significant control over pricing, allowing them to maintain healthy profit margins even in tough economic conditions. This resilience is appealing for investors seeking mobility. Monopoly companies typically generate substantial cash flows, enabling them to pay regular dividends to shareholders. This makes them attractive to income-seeking investors looking for consistent returns. Lastly, monopolies are well positioned to take advantage of growth opportunities in their industries. Their market dominance allows them to explore new markets, expand product lines, and innovate, all with fewer competitive pressures. Now, let's look at the risks of investing in monopoly stocks. Monopolies are subject to increased government scrutiny and regulatory changes that could affect their operations. Investors need to monitor these developments carefully, as changes in laws and policies can have significant impacts. The lack of competition can lead to dormancy, causing monopolies to underinvest in research and development. This can hinder long-term growth and make them vulnerable to disruption by more innovative competitors. Monopoly stocks are heavily tied to the performance of their industry. If there are shifts in consumer preferences, technological advances, or other disruptions, the performance of monopoly stocks could be negatively impacted. Lastly, given their already large market share, monopolies often have less room for rapid growth compared to smaller, more agile competitors. This could limit their potential for significant expansion. In conclusion, investing in monopoly stocks offers a mix of stability, strong profit margins, and growth potential, but it comes with certain challenges, regulatory issues, innovation risks, and the company's ability to adapt to market changes are all important factors that investors must consider before making such investments. Having said this is Neha signing off.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.